Hi, I'm Jim Flauaus. I work with a lot of taxpayers who end up filing returns and cannot afford to make the payment because of sickness, a downturn in their business, or other problems that arise. And so the great answer in this case would be to set up a IRS monthly payment plan. I just wanted to review a few of the questions that I typically get about IRS installment agreements or payment plans. So first of all, what is it? Well, an installment agreement is a monthly payment plan to pay off your back taxes. There's several types of agreements you can make with the IRS. Each of them have special rules, and so you want to be familiar with those rules. How long can you take to pay off your back taxes? Well, you have to realize the IRS has a completely different objective than you do in setting up an installment agreement. Your idea is you want to take as long as you can and make the smallest amount of payment possible. Let's stretch it out. Let's make the payment small. On the other hand, the IRS knows that the average taxpayer will default on their installment agreement in a 48-month period. Consequently, while you might be able to get a 72 or even an 84-month agreement in some cases, the IRS knows most people are going to default in 48 months. So they're all about getting things done and getting it done quickly. They want the maximum amount of money and they want it quickly over the shortest possible time period. So what's the minimum payment you can make? Well, the fact is, the real question is how much do you owe? Because the amount of money you owe the IRS is going to determine the minimum payment that you make and even the extent of the length of the payment agreement. So if you owe, let's say, $10,000 or less, you can go online and you can make an automatic payment agreement online. It's guaranteed to be accepted by the IRS. More about that in a minute. If you owe over $10,000, you could make a streamlined agreement. A streamlined agreement is one that is advantageous because the IRS does not require you to submit a financial statement in most cases. If you owe over $50,000, then you're going to have what's called a regular installment agreement. And in special situations, there's a fourth type of an agreement, and this agreement is called a partial pay installment agreement. And it's really a great deal because it allows you to make payments that will end up being less than the total amount you owe the IRS by the time the 10-year collection statute expires. So how do you get started? Well, with the basic agreement that is for $10,000 or less, you just go online to irs.gov, hit the search bar, type online payment agreement, and follow the steps. You'll end up with a 36-month payment agreement, and usually one that you can afford. If the amount is over $10,000, you have to call the IRS, which right now, as you know, you can sit on hold for an hour or more even to get to talk to somebody and work out a payment agreement on the phone. Or you can submit a Form 9465, an installment agreement request. If the amount is over $50,000, you're going to have to not only submit a Form 9465 installment agreement request, but you also are going to have to submit a financial information statement, which the IRS is Form 433. This can be a little bit daunting, but those are available for download, which you can then file with the IRS. So if it's such a great deal, if I can pay my debt off over time, what's the downside? Well, the downside is most taxpayers end up getting into a payment agreement that they can't afford. The monthly payment agreement may sound great now, but after a few months or a downturn or something unexpected comes up in your finances, you can no longer afford to make the payment you promised to make. Another downside is many taxpayers don't understand the difference between their actual expenses and what are allowable expenses by the IRS. You see, the IRS has what are called financial collection standards, and these standards establish local and national levels of what's acceptable to the IRS in terms of monthly housing payments, monthly food payments, and so forth. Why does this matter? Because at the end of the day, if you're going to submit a collection financial information statement and you're going to apply for a IRS installment agreement, what your actual expenses are may not determine what the amount is the IRS is going to expect you to pay. You may have an $1,800 house payment, but the local standard for your size family may only allow a $1,200 payment. So that other $600 is an amount the IRS is going to expect you to make payments for, when in reality your actual expenses may not be so. So you end up defaulting, and if you default on a payment agreement with the IRS, you can end up in worse shape than you start, because good luck on getting a second chance. If you have questions about IRS installment agreements, you owe back taxes, you want to know how to set one up that's affordable and which will help you to alleviate your debt and get out of trouble with the IRS and get a fresh start, contact me. Here's my contact information. I'm Jim Flauaus, President, Anchor Tax Relief. I help taxpayers in trouble with the IRS to settle their debt, end their stress, and get a fresh start. I'd be glad to talk with you further if you contact me. That's it for this time. I trust this information has been helpful to you. I'll see you next time. So long for now.